range-bound situation in gold and silver is ending. It wouldn't shock, and I kind of hope it does happen, that with the Fed meeting today, that something causes gold to spike to a lower low again. Now, its lows have been so far above 39.50. So let's go down and hit 39.50 to make a, quote, new low. Because I think that if you do that, you could get a compression situation where instead of this quietness we've had, you get this noisy spike that vertically turns around. 500 silver is probably minimal. Gold's well over 8,000. If you look back at gold, you mentioned 4,000. It's been floundering either side of that. But in that first drop, so somebody's accumulating this thing. Because when you punch out an old low, you don't collapse anymore. You go down, another $50 in gold. Big deal, The same with silver. He made a low at 64, made a low at 61, made a low at 55. Right now we're 57. We think what we're looking at right now on gold and silver is not long-term momentum. It's already positive. And JP Morgan came up with 9,200, I think. Getting there will be very rapid, but two, government bond crisis will move to the 4.
Gold has been flirting with 4,000 for the past month or so. It does seem to me at least that we've bottomed at that level. What do your charts say?
Yeah, we gave our last buy signals on gold and silver, major long-term investment grade buy signals, not get in, get out type signals. We're in March of 24, we said, okay, the range-bound situation in gold and silver is ending in the miners. Time to go long, March of 24. We were focused on silver primarily then. It was about $25. Okay. Next phase was in June of 25. Silver then was approaching 35 because we think silver is going to outperform gold in the coming year or so. And then our final signal was at $56 in November of last year. And if you think about the drop we just had, and we thought there would be a very dramatic upside in the metals. And I don't mean what we saw up into January. That wasn't the dramatic upside. I think we're going to go a lot higher.
Yeah, like 300 to 500 for silver,
300
right?
to 500 silver is probably minimal. And gold's well over 8,000. I'll remind me to come back to that issue, the 8,000. Yep. But the drop, we expected a sharp drop in the middle of this massive move that we expect to see. And we got one, but it came faster than we thought it would occur and a bit earlier than we thought. We thought it might be March or April before it happened.
Wall Street keeps calling this a topping market, yet long-term signals never actually broke. Michael Oliver notes his major buy signals began in March 2024, long before today's fearful headlines dominated sentiment. The sharper than expected correction looks less like failure and more like a reset that forced impatient capital out before institutions reposition. Investors chasing headlines risk missing the larger cycle already unfolding. Next, Michael Oliver reveals why the timing of this decline may be the strongest bullish signal yet.
It happened in the last day of January. In fact, the break was really a day and a half. Most of the drop was a day and a half, literally hours. And if you look back at gold, you mentioned 4,000. Yeah, it's been floundering either side of that. But in that first drop, in the first early days of February, got to 4,400. Okay. We've been trading, we were 4,100 a couple of days ago. Okay. So it's 6 months have passed since late January, early February. And we've really, most of the shedding of price occurred then, not now. Silver's drop then was to $64. We were up at 61 too a week ago. So again, 6 months have passed and we're trading a relatively small amount below where we were 6 months ago. Yeah. So yes, it's still been under pressure, but it's not really dropping much. Just enough to upset people, but not really consequential.
Because I talked to Daniela Martina Booth the other day, and she also described the gold market as like we had tourists, and most of the tourists have left. I guess these were also the momentum traders. And the weak hand, so to say, and the
guys who bought, the people who bought at 5,000 gold and $110 silver, they didn't buy at the right point. So you pay for that sin. Okay.
Interesting. So in your perspective, we could have reached the bottom for now, for both for silver and gold, and it's a matter of the right momentum then I guess for more people to come in, because you also said earlier that sometimes people are just fed up with an asset.
The biggest price damage happened within hours, but the psychological damage has stretched for months. According to Michael Oliver, nearly all of the decline occurred during the late January collapse, while prices have largely stabilized since then. Markets often exhaust sellers long before confidence returns, creating accumulation periods invisible to most retail investors. Those waiting for perfect certainty frequently discover institutions already bought the recovery. Next, Michael Oliver exposes the overlooked momentum signal quietly forming beneath today's sideways market.
Maybe that also was the case with gold. And
I think that's what's happened, yeah. The drop really occurred then, late January, early February. The most of 90% of the drop occurred then, boom. Since then, it's been up, down, up, down, up, down with slightly lower lows. So somebody's accumulating this thing. Because when you punch out an old low, you don't collapse anymore. You go down, another $50 in gold, big deal, Same with silver. He made a low at 64, made a low at 61, made the low at 55. Right now we're 57. We think what we're looking at right now on gold and silver is not long-term momentum. It's already positive, and this break, sharp as it is, has not in any way altered the long-term technical trend factors of gold and silver. It's not broken anything on momentum. Therefore, we shift to intermediate trend factors, the kind of factors that come into play and then come out of play over spans of several months. Okay, intermediate trend turned negative when we collapsed. Okay, since then, our intermediate momentum charts that we plot, not looking at price so much, but momentum of price, have developed basing actions. Hyper clear. When you looked at the momentum charts, you say, wow, what a base. The only thing you need is to punch up through the top end of the base to get the buy signal. We're toying with those levels over the last few weeks, and they seem to stop right at our numbers. We put each weekend, we update our numbers.
Price keeps testing fresh lows, yet panic selling never follows anymore. What Michael Oliver is highlighting is that momentum has remained structurally positive, even while headlines focused exclusively on falling prices. That disconnect often appears when stronger hands quietly absorb supply as discouraged investors exit. Missing these transitions can cost portfolios far more than enduring temporary volatility. Next, Michael Oliver reveals the exact trigger that could flip quiet accumulation into an explosive breakout.
They come right up to our numbers and pause again. It wouldn't shock, and I kind of hope it does happen, that with the Fed meeting today, that something causes gold to spike to a lower low again. Now, its lows have been so far above 39.50. So let's go down and hit 39.50 to make a, quote, new low. Because I think that if you do that, you could get a compression situation where instead of this quietness we've had, you get this noisy spike that vertically turns around. Quite often, that's how markets will do it. They won't end quietly. They'll end with a fake out. So I'm kind of hoping that we get some kind of negative today that's interpreted like, the Fed's going to raise rates or the Fed's going to be tough. And we get that because I think we're very near that upturn. On the other side of that upturn, I think gold is going to go well past 8,000. Now, why 8,000? The prior bull moves in gold, since it was legalized, went from the 1976 corrective low, it was legalized in 75, had a drop to 103 in 76. From that low, you went to 850 by 1980. Eightfold move. Then you made a low, 2001 and 2, at about $260, $255. Next high was 1920, another eightfold move. Different spans of time. Our low was 1,050 in 2015. The last major bear low. Eightfold move says 8,500 or so.
Interesting. That neatly aligns also with the Deutsche Bank's forecast that gold could go to that same level in a few years from now.
The market may need one final scare before rewarding patient investors. Michael Oliver's argument suggests a false breakdown could become the catalyst that traps late sellers while institutions step in aggressively. History repeatedly shows major bull markets often begin with maximum confusion instead of widespread optimism. Investors focused only on Fed headlines may completely miss the structural reversal underneath price action. Next, Michael Oliver unravels why historical gold cycles challenge today's mainstream forecasts.
And Morgan Stanley came up with, JP Morgan came up with 9,200, I think. But we argue that one, getting there will be very rapid, but two, these other events that are fundamentally major, like the government bond crisis, will move to the fore instead of being hardly chatted about. And the whole public perception and government perception of what's going on and how dangerous it is will change all assumptions about what central banks are going to do. And there's only one thing they can do. They cannot let the house burn. Exactly. They have to print. They have to buy those bonds. And that means print the money, meaning accelerate the monetary growth. And we all know that that's what gold lives on.
Yeah. Do you sometimes encounter situations where you fundamentally or even philosophically believe you need to own an asset, invest in an asset? You wrote the book, The New Libertarianism, Anarcho-Capitalism, so you're a free market guy. That's also one of the reasons, I guess, why you like gold and silver. But it could be that gold and silver break a certain trend, and from a momentum perspective, it's not interesting to buy them, but from a philosophical point of view, you need to own them. So is it sometimes a conflict within your investment decision? Process?
I do not let my philosophical base, let me briefly explain it. The book, The New Libertarianism, Anarcho-Capitalism, was a master's thesis I wrote in 1972.
Wow.
Long time ago. Back then, I knew Dr. Murray Rothbard before most people did know him. And he and I communicated with letter. And also, I went to his apartment in New York and interviewed him for a newspaper I was running at the time.
Government bond stress becomes everyone's problem once central banks start creating money again. This is where Michael Oliver's thesis shifts from technical analysis toward the monetary consequences of systemic intervention. Investors should watch policy actions instead of speeches, because liquidity injections eventually reshape purchasing power far beyond financial markets. Protecting wealth means recognizing where currency risk quietly transfers onto savers. Next, Michael Oliver reveals why philosophy alone should never determine an investment decision.
He's the father of modern libertarianism. He died in the mid-90s. But I knew him in the early 70s, and he wrote to me a letter that said, I explained to him what I was writing, and he says, yours will be the first one to explain anarcho-capitalism. And but I do not allow that broad philosophical base to interfere with my analysis. For example, 2011 gold peak, $1,920. So I think it was September 2011. We turned major bearish 3 months later. Barely off the high, a couple $100 off the high. We said, it is over. You're going down big. What did gold do? After we said that, it went sideways, never went back to its high. Went sideways for about a year. And in spring of 2013, collapsed finally and went to 1,000, got cut in half. Then went to 1,050. Yeah. And then we turned bullish in February 2016. But we did turn major bearish despite a fundamental appreciation of long-term value of gold as a stable place to have money. In other words, not to have money, that is money. The things we call money aren't money. They're fiat currencies. And ultimately, history proves this to be correct. Gold as money has outpaced the degradation in the US dollar measured by the M2, the money supply. Which money supply going back to 2000 to the present, so over a quarter of a century. How much has M2 gone up percent-wise compared to gold? Gold has outpaced it vastly. It's been a better place to be than the growth in the money supply. So it has saved you from the degradation in the money unit. S&P has matched the degradation in the money unit. I mean, it's gone up as much since 2000 as has the money supply, meaning it really hasn't made any real value, gained any value. It's held its own versus the degradation in the money unit. So from an investment point of view, which is done better? gold or the stock market. Most people would not know that the gold has vastly outperformed the stock market over an investment lifetime. And I think that's about to go crazy.
Most investors mistake conviction for discipline, and markets usually punish that confusion. Michael Oliver notes he turned bearish after gold's 2011 peak, despite believing in precious metals for the long run. Separating evidence from ideology is exactly what many institutional investors do, while retail investors become emotionally attached. Protecting wealth requires adapting before narratives finally change. Next, Michael Oliver exposes why gold's long-term performance challenges conventional stock market assumptions.
So both you and I expect gold and silver to go up. We expect a sovereign bond crisis, central banks to print massively. But what comes next? What do you think will come after, and what do you like to see after?
Well, I'm not going to specify what I'd like to see. You can read my book about that. But I think what's going to happen is that gold and silver will ultimately become a panic point for the public where they will rush into it because it literally becomes the only place to be. Now, basic commodities will also come into play here. I think they're an investment grade situation. I don't think they're meteoric, but I think they're an investment grade place to be because they're vastly undervalued. And I think the money will move there. But what happens right now, we don't have extreme emotion in the markets, in the stock market, for example. Right now, anybody who has a retirement account at least is smiling, saying, well, my retirement account's up from a year ago. That's the only thing he's got to smile about. It's not his cost of living. It's not his mortgage. It's not the fact that he's past due on his credit cards like nobody's been since 2008, whatever. It's that his stock market's up. But if you take that away from him, you interject emotion into the public, because then they have no sense of an anchor or something to grab onto. Then they're desperation. So you go from calm to emotion. Stock market will help precipitate that.
Complacency usually disappears long before investors realize their safety net is gone. According to Michael Oliver, confidence can evaporate quickly if rising stock portfolios stop masking deteriorating household finances. That shift transforms calm markets into emotional markets where capital seeks protection instead of growth. Savers ignoring these transitions often react only after prices have already repriced risk. Next, Michael Oliver reveals why commodities could benefit from that emotional turning point.
The government bond situation will create even more panic, because if that's not a safe place to be, then the whole world has been turned upside down. Meaning concepts that we've had for 100 plus years, institutions we've had like the central bank, Federal Reserve, and so forth, will come into question in terms of, gee, do those really work? Or are those creators of dysfunction? You look back at the history of the Fed, they create boom-bust cycles. Monetary expansion, stock market goes up, then suddenly you get excess, stock market breaks, the Fed panics again, prints more money. It's like a boom-bust cycle. And I think there's a growing awareness of that among academicians. But what will really bring it to the front is when you get into a crisis mode and markets hurt people. And that's when suddenly any talk about what's going to happen will go tabula rasa. I don't know, but I know a lot of concepts and institutions will probably be just simply puked out. They don't work. And therefore, to some extent, it's like it's a nuclear event. Mankind will be looking for alternatives. So what do we do now? One example would be Javier Milei in Argentina. He had used to be the seventh biggest economy in the world, Argentina, back 50, 70 years ago. Okay, now they've become a third world country. Two political parties, like Democrats and Republicans, vied for power there for decades. They were both socialist in effect. They had a socialist economy. You had inflation. You had all kinds of pain on the part of the lower income people about rents, prices, even though they had, quote, rent controls, government controlling the rent market.
The safest asset can become the biggest source of panic when confidence finally breaks. What Michael Oliver is highlighting is that bond markets, not gold, may determine when public trust in financial institutions begins unraveling. Central banks often promise stability, or repeatedly expanding interventions after every crisis emerges. Investors should watch policy responses more carefully than reassuring headlines. Next, Michael Oliver exposes why institutional confidence can disappear faster than retail expects.
Here comes a guy in there, and the young kids of today, not the older folks, the young kids said, it's not been pleasant life. We need something new. And no, they didn't understand that Javier Milei, who declared himself to be an anarcho-capitalist, not a libertarian, anarcho-capitalist, started tearing government down. And one of the things he tore down was the rent control of government. But this is, again, a situation where emotion takes over. People vote for him, not necessarily knowing the explicitness of his ideas, but knowing he's going to change things. We need to tear stuff down. And he started tearing it down. And when he got rid of the government control over rent prices collapsed. The average guy could afford rent. And I mean, it literally collapsed. Inflation's come down dramatically there because they had a fit. In other words, it takes pain to have a fit. I think that's about to happen globally, where enough discord will occur because of the pain that new ideas will move forward that people hadn't even thought of before.
Major policy shifts rarely begin with consensus. They begin when public frustration becomes impossible to ignore. Michael Oliver's argument suggests financial pain often creates political change long before economic textbooks acknowledge it. History shows entrenched systems usually survive until ordinary people lose confidence in familiar solutions. Investors should prepare for policy surprises rather than assuming today's framework remains permanent.